traditionally banks are what you call this 363 rule. Banker gets in to the office, they collect deposits at 3%, and then after that they sell a loan product or they lend out money at 6%, and at 3 p.m. they're off to the golf course. Loans to deposit ratio. So analysts, experts, they like to look at banks in terms of their capital. That means how much money are they actually holding. Very healthy banks with good balance sheets, they tend not to lend out more than the deposits they have. Interest rates go up is good for the banks. Why? Because when they lend out money, they're able to lend out at a much higher yield or a much higher interest cost. And what's really driving the performance of these banks is actually diversifying into wealth management. How these big banks are growing. They have a different market. They're actually looking towards savers who actually want a higher interest rate. But if you look at the three local banks, most of their profits are still coming from the traditional savings and loans business.
World First is back with us at TFC today. Yes, for all you aspiring professionals turned business owner and or side hustlers, you will quickly realize that you lose a lot of money simply by moving money around. A few percent here, a few percent there, it adds up. So World First offers you competitive FX rates for your international transfers starting as low as $1, helping you maximize your money and stay competitive. I will share with you a little bit more about their latest product in the podcast. So meanwhile, let's roll. Welcome back to Chills with TFC. I'm your host, Reggie, aka your Chief Financial Coconut. And today, I want to do an episode that is quite important because Singaporeans only care about these few things, right? When it comes to investing in the Singapore market, is the financials and the REITs. Pretty much, these are the two main things. So we've spent a lot of time covering REITs. So today, we want to spend some time talking about the financials, the big banks. Is it investable and all that good stuff? So for the benefit of today's episode, I could only find a good friend on the show.
Only, I don't mean sound like, last minute.
No. Because you think about it, the
Walao.
bankers will not talk about themselves, right? So all the analysts, they don't really want to talk about their boss, which I get it, right? So, so a good friend on the show, Willie, welcome back. For our listeners that somehow don't know you, you want to do a quick intro?
Hi everyone, my name is Willie Keng. I'm the writer and founder of a financial blog called dividendtitan.com. I've started writing since 2020 and we've grown to about 30,000 readers a month, and I talk about dividend investing. I personally cover Singapore stocks, China and Hong Kong, and the US market as well.
Oh, so you're ahead of time because now the trend, China is back, right?
I've
I know,
always
you've
been
always
ahead.
been there, I know.
Look, I've always have a soft spot for China, and this is something which I like. Sometimes it's better to be early than too late. So
Okay. That's a different episode, right? You can check out some of the other things we did. Help us understand, right? Like we've established in the start of the episode, there's a palette, right? Singaporean investors love investing in the bank. Love it, right? For some reason, right? You feel free to expound a reason from your point of view as to why you think it's like that. So we'll break this into two parts. First part, we try to understand the business of the banks, how do they make money, understand their fundamentals, evaluate them. So give our audience a framework. And then part two is the exciting part. Part two is which bank is better, amongst the three. That's why they don't want to come on the show, you see? Never mind, we give them a break. So maybe for a start, right, help us understand, how do banks make money?
So there's always this good saying about banks. Traditionally, banks are what you call this 363 rule. So 363 rule means that banker gets in to the office, they collect deposits at 3%, and then after that they sell a loan product or they lend out money at 6%, and at 3 p.m. they're off to the golf course. So this is basically what a banking business is all about. You basically take money from depositors, from other people, so you call it other people's money, you park it in your bank, and then you take this money and you lend out at a much higher interest rate and a longer term maturity than the deposits. So what you do is you basically collect a margin or a spread between what you pay on the deposits and the yield which you're collecting from the loans or any investments which you are making for a bank. So bankers tend to be a very simple, easygoing job in the good old days, because this is basically what you do. And a lot of the financial institutions, they are usually called what you call a savings and loans kind of business. And the banking business is a pretty straightforward business because you are just using other people's money to invest in higher yielding longer, what you call longer maturity products, which is your loans, your corporate loans, your mortgages, your personal loans. And in essence, that is what the banking business is. The good thing about banking is that it's a well-regulated industry. I mean, these days, you don't really hear about new licenses issuing to traditional banks. I mean, you have the digital banks, of course, but traditionally, when we are talking about banking license, you don't have governments or countries just issuing the licenses to any person or any companies at all. The barrier of entry is high. So that's one thing about the banking business. Another thing also, what people would want to focus on and what I would actually focus on is actually looking at the deposit franchise. Now, the banking business, because it's a very commoditized business, when you're lending out money, you don't really have that kind of competitive advantage, because as long as your competitor or your peer is willing to lower the interest rate on their loans, customers will just go to that bank itself.
Yeah.
So where the competitive advantage comes from for banks in this case is your deposit franchise, the ability to attract deposits, some form of like a magnetic field, right? If you're able to attract deposits, you're able to retain those deposits. That gives you a lot of firepower to lend out money to, companies, to individuals for their own mortgages or for their own businesses. In essence, that's what the banking business is.
And I know you tried to allude to the banking business as very regulated and all that, right? But recently there's some saga in the US, there's internet saga, we don't need to go there. As part of this whole regulation exercise, there's a big part of how much you can loan out, as a fraction of, your deposits, right? It's just essentially the capital that you hold, right? Which is what you alluded to. Can you kind of help us understand, like, if not that, I just keep lending out, right? My risk premium keep going up in the bank itself. So help us understand that part of the business.
Maybe I will just share with you what are the 3 big points when I come to look at a bank. So the first one, which you have pointed out, Reggie, it's looking at what you call the loans to deposit ratio. So analysts, experts, they like to look at banks in terms of their capital. That means how much money are they actually holding? Because that's very important. In a bank run, weaker banks tend to withdraw deposits out much faster. And that could be a huge risk, because that will actually cause the banks to have insufficient money to pay their depositors. Now, when you look at banks or any financial institutions, it's important to pay attention to this. So for banks, I look at a very simple metric called the loans to deposit ratio. What this means is, if I collect $100 of deposits today, how much can I lend out as a bank? And very healthy banks with good balance sheets, they tend not to lend out more than the deposits they have. So let's say if they collect $100 deposits today, they probably would lend maybe about $60, $70 of deposits.
Oh.
This is crucial because it sends out 2 big signals. Number one, they are healthy enough. They have a very conservative, good risk management. That means they don't lend out all the money which they have. Number 2, it also keeps their cash for rainy weather. So in case if, let's say, they need to increase their firepower to lend out more money to individuals or to companies in a very healthy environment, they can increase the amount of money which they lend out to their customers, right? So if I collect $100 deposits, today I lend out $60 in good times, and if I want to take advantage of opportunities, I can actually increase from $60, $70 to even $80. So that's how I calculate my loans to deposit ratio. And it's very crucial because if you see across the different economies, across the different countries, you can tell what are some of the very aggressive kind of banks, what are some of the banks which have very strong risk management. Now, in 2007, 2008, during the global financial crisis, a lot of banks, they were very aggressive in lending. And you can start to see this loans to deposit ratio starts to go up. For instance, you have Lehman Brothers, where they have started to increase this loans to deposit ratio. Over the last couple of years, in recent time, if you look at your Credit Suisse, for instance, where they got acquired by UBS, they also started
Quiet is a nice way to put it.
they increased their loans to deposit ratio quite aggressively. So looking at loans to deposit ratio is one way which I will look when I try to assess a bank, and even for a local bank. So the other 2 ratios also tie very closely to it. The second one which I will look very closely is the amount of deposits which they have, right? This is important because banks, the way they finance themselves or the way they run their business is they use deposits. They make use of deposits to lend out to their own customers. The problem comes when banks, when they try to be very aggressive and they find themselves having not enough deposits to grow. So this comes when banks starts to borrow money from other banks, not in terms of deposits, but in terms of loans. So you have banks which also borrow from other banks as well. And you can see that during the global financial crisis where Lehman Brothers almost half, I would say a big chunk of their liabilities in the bank were actually borrowing. So they were borrowing money from other banks as well. Now, this is a big problem because if the bank has a very strong reputation, typically in times of crisis, you still have your deposits intact in the bank account, which is great for any bankers. The problem comes when you do not have enough deposits and when you have all these borrowings from other banks, and usually they're very short-term borrowings. And when it comes to refinancing or payday, when they have to return the borrowings, the money or the debt to other banks, when they find themselves, other banks do not want to lend them anymore, or the interest rate, the cost to borrow goes up, this could be quite disastrous for the banks which borrow a lot of money. So it's important, I'll look at the deposits, the amount of deposits which a bank have. So typically you want a large part of your balance sheet to have a lot of deposits because that signals very, very healthy business for the bank. So that's the second thing which I will look at. Now, the last thing is something which all investors definitely will have to pay attention to, which is the profitability of the bank. So profitability is looking at the profit margin. And there's this term called the net interest margin. That means you are basically taking the amount of interest income which you're collecting from your customers minus off whatever interest cost which you pay on your deposits divided by the assets which you lend out. So typically you want to have very steady profit margins. That means a steady net interest margin because this shows that you're able to control the amount of interest cost which you pay to your depositors. And at the same time, you know how to competitively price your loans across mortgages, across your products, your company loans, for instance, which you lend out to. So this is actually very crucial. In good times, you have higher net interest margins. Of course, in bad times when people are not exactly borrowing money, that's where you start to see a pressure on your net interest margin. So these are the three simple key ratios which I look out for as an investor, as an income investor, because these three will determine, whether the banks can be profitable. That's one, and ultimately, which is my favorite, whether they're paying out dividends.
Of course. Let's talk a little bit about the interest margin side of things, right? Because by virtue of managing interest margins, we are today at a high interest environment, right? So the banks are having a great time, right? So that's why they're not squeezing every corner. There was later we can talk a little bit about like just a few years back, right, where interest rates were so low, the banks were innovating 101 ways to try to make money in different methods, right? But now they're all very chill with some of the more innovative strategy because interest margins are so much higher, and that's why you see some of the local banks, the valuation run up, it's really, really up there, right? So is that a fair statement to say that today we are kind of at like peak interest, and then there's a very high propensity for it to start to move down and then you will see interest margin compress? Is that fair?
I think for me, I don't have that crystal ball, right?
Yeah.
No one has. What I would say is that you can see where the trend is going for interest rates. Last year, the US Federal Reserve has said that they are looking to potentially cut interest rates because they're looking at
But they say very long already.
Yeah. So they're looking at inflation falling. Yeah, I mean, they've been saying for quite a while. And in fact, you see this year, at the start of this year, they're looking to actually push back their interest rate cuts. Because of a couple of things, right? You have the trade war, which might actually have a pressure on inflation. Banks are definitely affected by interest rate cycles, and interest rates do move in a cycle, right? The way they move is that they go up like an elevator, but then they can fall like a feather sometimes. So it really depends on how the interest rate environment is. However, what I'll have to say is that a good bank is able to actually manage their business alongside with the interest rate cycle. So banks, right, if you noticed, the way they make their money, their profit is driven by two big factors. Number one, like what we have mentioned, interest rates. Interest rates go up is good for the banks. Why? Because when they lend out money, they're able to lend out at a much higher yield or a much higher interest cost, which is very in line with the general interest rate environment. So high interest rates, as you can see over the last couple of years, the profit margins for our three local banks, DBS, OCBC, UOB, they've been doing pretty well, right? In terms of the profit margins. Now, banks also are able to pull another lever when it comes to profit margins. Now, when interest rate drops, what happens? The natural thinking is that banks might actually have a squeeze on their profit margin, which is true. I don't disagree with that. However, if you see over the last 15 to 20 years after the world came out from the global financial crisis, when all the financial institutions, they were wrecked. They had very damaged balance sheet profiles. Interest rate was close to zero. What happened was that a lot of the banks started to aggressively expand the amount of assets to lend. That means they were lending out more money at a very cheap interest cost. So banks, they can also make money from increasing the volume of loans which they lend out to their customers. That means I can just, Reggie, if I go to buy a house today, I can try to entice you with very cheap mortgages. And I say, hey, come and buy your property. We are able to lend you a very low interest cost. Or if let's say if you want to grow your business, you walk into a banking branch and, the banker will say, look, I can offer you very attractive rates. And they can be very aggressive in trying to market out and trying to lend out more of these assets to their customers, which is great for banks because lower interest rates, but you expand the volume of assets and loans which you are lending out to your customers. So you can see over the last 15 years, even though interest rates have been low, before the interest rate hike in 2022, banks were still making good money. They were profitable. You can see the 3 local banks, they were still making good money as well. So these are the 2 main levers when it comes to banks' profitability and how they can actually adjust their profits with regards to their interest rate cycle.
But just to be clear, tying back to what you've tried to lay down the framework in the front part, when they do more aggressive lending, then essentially they are increasing their risk profile, right? As a bank, they're increasing their risk exposure because now the volume is bigger relative to the deposits. That's a fair statement?
That's a very good comment. So at the end of the day, it's also managing both, looking at the profitability of the business. They can be very aggressive. This means that they also need to be aggressive in collecting the deposits to increase the capital which they have. That's why you see local banks, there's so many promotions going out there.
I know.
My wife, every other night, my wife will be telling me that she wants to open a new account because of the attractive promotional interest rate. So banks have been very competitive in attracting deposits so that they can be aggressive in lending out money to grow their business. So you are absolutely right in pointing out that being aggressive on one hand is a factor to grow the profits. But on the other hand, banks also need to watch out for their risk management, whether are they overlending and whether they have enough deposits to be able to cover the loans or the investments which they're making.
Based on what you say, right, it doesn't really sound like a very complicated business.
Oh,
right?
It's simple. Always remember it's a 3-6-3 business. I lend out at 3%. No, I collect deposits at 3%. I lend out at 6%, and I hit the golf range by 3 p.m. Simple business. There's no OT. And then I just sit back and enjoy the margins which I collect from my customers.
Annoying.
This is what it is. I love this kind of operating model.
Fair. Hey Coconuts, I'm very excited to introduce you to the latest offerings from World First. World First is an all-in-one business account that fuels your business worldwide. Their latest product, the World Card, is a multi-currency business card that allows you to get unlimited 1.2% cashback on all your business spend. If you use it on Meta Ads, Google Ads, ChatGPT, Salesforce, and more, you get additional benefits. Of course, subjected to change, terms and conditions apply. But more importantly, if today you are looking to start your business, whether it's in retail, e-commerce, or B2C, World First is your partner. Check them out, link in the description below, and back to the show. That is a quite an old, business model, right? Over time you start to see new innovation in the business. I mean, you look at all the banks, when they break down their revenue, then they will show you like where are they coming in with on the other verticals, right? So other than this loan interest business, which I think everybody kind of understand now, what other things are these banks doing and making record profits?
I would say it's more than just record profits. If you see the share price, it have been hitting at all-time peak. A lot of what you have pointed out is really driven more by the innovations and the diversification of the business which these banks have been making. So if you see the last couple of years or the last 15 years, right, banks have been making good money, shares have been growing steadily because of their bread and butter business. The loans business is generally very healthy in Singapore and within the region because people still want mortgages businesses still grow and expand. Now, what's interesting for these banks is, and what's really driving the performance of these banks is actually diversifying into wealth management. So wealth management has been a big part or growing pie of the business. And this is something which I've been writing on my blog, talking about Singapore banks, how they have actually grown their business based on the wealth management segment. So if you see last year, while their growth in their traditional loans business is steady, they don't have really huge growth. The primary growth driver is actually coming from their wealth management business. So what is wealth management business? Wealth management business is basically the banks attracting affluent to very wealthy customers like yourself, Reggie, to come in to the bank, to put money in the bank and say, hey, I want
unlimited free coffee. Right. Send the car to the airport. Yeah, those type, right? Yes.
So
not that I know. Yeah, hearsay, yes.
So Reggie, you might walk into a bank branch and you might say, hey, I have $1 million.
Why do I need to walk into the bank branch? The bank walk into me.
Can call, yes. So the banker can call you.
Audience, right?
So the banker calls you and you say, and you tell your banker and say, hey, I've got $500,000 or $1 million to invest.
Yeah.
Help me to invest.
Yeah, and so I got 15 minutes at SICC. You come here now.
Exactly.
Yes.
All this money which collects from, people like yourself, from affluent, high net worth individuals, this grows the part of the wealth management business. And when you put money with the bank to grow your assets, to grow your investments, they typically charge you a fee, a management fee, a platform fee. This fee income or this recurring income has been growing over the last couple of years because our local banks have been very strong in attracting wealth, not just in Singapore, but across the region. So you have not just, more than just within Southeast Asia, you have from Hong Kong, from China, for instance. In fact, when Hong Kong had the Occupy protest, when they had a political shakeup, and when you have the China real estate clampdown a couple of years ago, a lot of the money actually started exiting from the world's second biggest economy, together with Hong Kong.
I mean, even George Yeo is back. And he famously said, because he didn't feel safe there, so he's back, right? So yeah, you get the idea.
So a lot of money actually comes into Singapore, and Singapore becomes a natural magnet for wealth. I mean, if you look at Asians, typically you can put money with, so the three big wealth hubs, Switzerland, Hong Kong, and Singapore. Singapore is playing a big catch-up. Asians still prefer, home ground advantage. They still prefer to put money within the region itself largely because of a higher yield. You have a more controlled political climate, political systems. And in Singapore, typically you have a very strong institution. So this sets a very strong foundation to attract wealth. And you can see for our three local banks, wealth management has been a big driver. Last couple of years, you see wealth management having that big growth in their latest results last year. So this has been what's keeping the performance, their shares performance in recent times. That's why you see the STI hitting an all-time peak, largely because of these three banks. So wealth management is one big area where you typically look for growth in our three local banks.
And there's another big part of the business, which is cards, right? So and I want to talk about it together, wealth management and cards, right? Because this part of the business is where a lot of the fintech are attacking, or like the digital banks, they are trying to crack, right? Because the loans business is an age-old business, and it's not so easy to take a big loan from the digital banks. Like, would you really want to take a very big loan from a newer bank? There's a trust element to it, right? But some of these other parts of regular day-to-day banking, whether is it cards, whether is it wealth management, you see the fintech all over, like eating up the bank's business, or at least that's how they spread the narrative, right? And partly to get VC money, right? So what is your take on some of these risk factors, or or do you even see them as risk factors, or you just see it's just more vibrancy? It's not really eating up the big banks.
My readers have asked me over the years about digital banking. Every time when I talk about Singapore banks, definitely someone will talk about digital banking. I would say that digital banking is not so much of a competitor. I would say they are more of a complement to the main monopoly for these banks. And the reason why is very simple. If you look at how digital banks and what they're actually doing, they aren't necessarily trying to grow how these big banks are growing. They have a different market. They're actually looking towards savers who actually want a higher interest rate on their savings. So there's a very nuanced distinction in terms of their niche, in terms of their competitive advantage. Digital banks are not necessarily trying to disrupt the deposit franchise of these big banks, and they know that it's very difficult because the single most important thing which I want to share when it comes to a banking business is reputation. If you don't have that kind of reputation, you will never be able to attract the kind of deposits franchise which they can get. And this is not something which can be built overnight. Reputation takes a while to build, and it's like what Warren Buffett says. It takes a simple scandal or fraud to kill the reputation. So banks, our local banks have been building this reputation quietly over the years. If you put money, with our local banks, and one day I tell you, hey Reggie, you should just take out all your money and put it into the digital bank, you might not agree with me, because the first thing which you might come up is this digital bank going to survive? Is it safe? That's the first question I will ask on my mind. And inevitably, when it comes to safety, you would still put money where is the most reputable, because you know that these banks, the big banks, have been surviving for a very, very long time. They've passed through many different economic cycles. Digital banks, on the other hand, they tend to be more trendy. So they tend to offer, great promotions, higher interest yield, more so to capture a different part of the market. These are the customer group where they say, hey, maybe I want something a bit more than the deposit rate. I want something more than what DBS, OCBC, and UOB are giving. Therefore, I go into the digital banks. But will I take out all my money to put into this digital bank? Maybe not. Because my profile, my understanding, when I want to take out $100 to put into this digital bank, I just want to make a bit more than the savings which I get. Not necessarily to have that, safety factor involved, because I know the risk for digital banks. So I see digital banks and the big traditional banks as more of a complement, more so as just trying to disrupt each other.
So eventually they will couple the digital bank. And then
they could. I mean, if you see transport companies in Singapore, how the landscape is, eventually some of these may actually happen. So, time will eventually tell.
But I think that's a fair statement, because like some of the digital banks, when I first started using that, I put a bit of money in there. Over time, for some reason, the trust built up. Then you will put a little bit more. You put a little bit more. There's a time lapse to that kind of process, right? So the trust element is in the interest. So now part two. Now we got part one. Part one is the boring part, right? So if you really understand the front part, you can skip to part two. So this is the exciting part, right? So like you've said, the three big banks. I think we can also throw in some of the regional banks that are here, to kind of take relative comparison. But amongst the three big banks, people will want to ask you, which one will you invest? That's always the question, right? That's like the hack question, right? Yeah. So maybe, walk us through how do you think about them individually?
If you ask me,
You got a favorite or not? You got a favorite?
What to buy? I'll have a favorite. I will tell you later on. But first, what I will say...
learn all the hooks. I'll tell you later.
I'll come to that in a bit.
Okay.
But what I will say is that if you ask me whether I'll buy Singapore banks today, I wouldn't buy. Why? Because I find that, to be honest, in terms of the valuation, it's actually quite expensive. It's rich. The banks today, they're not offering the kind of dividend yield which I feel that they're supposed to offer to investors at this point in time. If you look at the historical trend, so maybe what I will do is I will look into how to actually look into the valuations for some of these banks. Singapore banks, they tend to be dividend dominators, very strong businesses which have been paying out regular dividends, growing dividends. And for dividend stocks, the interesting thing about dividend stocks is that there's this thing called the dividend yield cycle theory. Means that dividend yield of some of these high quality blue chip names tend to move from a period of high dividend yield to a period of low dividend yield. And this oscillation swings like a pendulum. So there'll be a period where banks will be cheap. There'll be periods where banks will be expensive. And today, if you look at where the historical patterns or the charts for these Singapore banks, they are trading actually close to their historical low dividend yield. Why is it? It's because people are generally very optimistic about the environment for banks in terms of the wealth management business. That's why they are pushing the prices up for many of these banks, and therefore the dividend yield starts to drop. So for me, I pay very close attention to this dividend yield cycle theory. And I mean, it's not something which I cook up along the way. It's not something which I bring to the show.
Titan cook this up, okay? Yeah.
So this has been around, there have been data showing how some of these dividend stocks, they typically tend to trade in such cycles. And why is because there's this thing called the client effect. Client effect meaning that typically income investors or dividend investors, when they invest in dividend stocks, they tend to be more long-term investors. So when dividend yield starts to trade higher, that means the yield starts to go up, income investors, they are bargain hunters, they will straight away bid up for the price of the stock, thereby pushing the yield lower. On the other hand, when the stock starts to sell off because of the bad news, the yield starts to go up. But at some point, there will be a certain ceiling or a certain limit where the yield will really trade, because long-term investors know the quality or the fundamentals for these banks. And at the end of the day, what they're buying for is dividends. They tend to be long-term buy and hold investors. So because of that, there's actually a group of fans or supporters for these stocks.
They are.
So because of this, this dividend yield theory sort of moves from, up and down. When I look at the banks today, they tend to actually trade slightly more expensive. So if you ask me, I don't think it's worth looking at. However, if you like to sort of dip your feet into the game, get your feet wet, for me personally, I like, in terms of priority, in terms of the yield, in terms of the quality, I like to be looking at, number one, I like to be looking at UOB, followed by OCBC, and then DBS is the last. Why? Is because today UOB actually trades at a much higher dividend yield versus OCBC and DBS. Another thing, if you look at UOB versus DBS, UOB tends to be in the traditional banking business. So they are still in the traditional loans business within the region. DBS, if you look at their growth, a lot of their shares, what's driving their shares performance is a lot from the wealth management business. But if you look at the three local banks, most of their profits are still coming from the traditional savings and loans business. That means I collect deposits, I lend out money for mortgages, to individuals, to companies. So I like that kind of stability when it comes to the three local banks. So UOB actually is my favorite choice. The least favorite at this point is actually DBS.
Maybe we expand that discussion a little bit, right? So I think recently there's been a lot of management changes. Also, whether is it UOB, whether is it DBS. DBS is like a fanfare exit, right? I was like, this guy running for president, is it? But anyway, okay, Piyush, you want to come? I will still invite you. Okay, welcome to the show.
You should get him.
Yeah. Come. Yeah. But how important do you factor management across these banks then?
I definitely give credit to Mr. Piyush. I think what he has done in digitalizing DBS over the last 15 years has been phenomenal. It has been great. But what I would say is, from the head of an investor, we always want to look at what you call key man risk. Because if a company is not able to survive, if the key man or the key person running the business or running the show, then it might not be a sustainable business. Because what this tells me is that this business doesn't have a systemized operating model where you can simply just put someone else in to grow the business. So for me, I think key man risk, having a key man, an exceptional founder to drive the growth of business is important. However, in terms of the long-term stability of the business, whether you want the bank to be making predictable profits year after year, I want to make sure that the bank or the business or any company has a sustainable operating model. That means even if the CEO or the founder gets switched out, the business can still run. Why is this important? Is because when I was an analyst in back in the banking days, I noticed that there will be cases where you have CEOs or founders committing frauds, where you have CEOs taking huge paychecks, getting ousted by board of directors, getting kicked out of board of directors because of personal reasons, because of political reasons. And if a company is not able to survive with that key man, then it gets very risky, because how do you foresee or predict this kind of political infightings? How can you predict as an investor, when the CEO or the founder would actually change hands? So for me, I think as looking at key man is important, but it cannot be the biggest driver in running the bank's profits or the bank's long-term fundamentals of the company.
Right, I don't disagree. It's such an old business, right? If you really need some like stellar person at the top to run the whole thing, that's also quite questionable. right. But anyway, yeah. So just now you were saying that valuation today is very rich, right? With the three big banks, you've stated your favorite. What is a valuation space that you would love? for some of the local banks?
Since I spoke about the dividend yield cycle, I'll assess banks from a dividend yield point of view. So for me, where it'll be interesting is when banks starts to trade at a dividend yield of about 6% or at least 6%. I think that is a very good range. Reason why is because number one, you have sufficient margin of safety. If let's say you have bought some of these high quality assets at the wrong price, you have at least locked in the dividend yield for yourself. And a healthy 6% far outbeats a lot of the stocks in Singapore, even for blue chip stocks. So you know that you have gotten yourself a pretty good asset or a pretty good business, which have been paying very predictable profits. So around 6% would be a good level. Of course, I think you still have to analyze on the last 10 years, right? Whether the range between the low dividend yield, the low historical dividend yield, and the high historical dividend yield, because this range can change over time as the years go by. Banks, sometimes they might have grown their profits even more. They might have paid out more dividends over time. Banks, they might have cut their dividends. So I think it's good to always observe the dividend yield historical charts or the cycle, at least over the most recent 10 years. So this is how I would see for banks. Of course, at the end of the day, it also depends on your own financial goals. People buy banks for many different reasons. Some, they want to maximize the amount of yield which they have. Some, they say, okay, look, I don't need such a high dividend yield. I know the bank is safe. Maybe a 5% dividend yield is good enough for me. Or maybe even a 4+ percent dividend yield is good enough for me. Then, of course, then it all boils down to your individual financial objective, how you actually want to invest in these stocks. So I would say there's no right or wrong, no hard and fast rule. Boils down to your own financial goals.
But 6% is your favorite, your reference point.
Yes.
Okay, great. So last question, right? I think we had a great discussion. Any question, put in the comment section. We may do more. Last question, which I want to link back to your other favorite, which is Hong Kong and China. Right? So you say the Singapore financials are, bidded up, which is true. You look at the valuations, they are through the roof, right? And you said that today, this point, you wouldn't touch them, right? You wouldn't want to add, essentially, you just keep whatever you have. You're not going to add. What about Hong Kong? They also have a lot of financial names, and the broad market is bidden down over there, right? So, are there opportunities? What are you looking at?
I would say that the opportunity...
That's a structural risk. That one got structure.
Sadly to say, the opportunity for financials is sort of gone and past the wind. If you want to know more, you got to find out from what I've been writing on my blog.
Read dividendtitan.com.
I would say that a lot of the financials, because of the recent China-Hong Kong rally, a lot of the financials have also done pretty well. If you look at the big four Chinese banks, for instance, they have done pretty well. Even for the local Hong Kong banks like HSBC, BOC Hong Kong, share price have actually improved, especially for HSBC after they have restructured their entire business. They've sold down a lot of their assets. Share price have actually improved quite a fair bit. Generally speaking, I would apply the same set of lens when I assess China Hong Kong banks. So looking at the three key indicators of the ratio, how much deposits they have, the loans to deposits, and the profitability, which is the net interest margin of this bank. So I'll actually assess them on some of these banks. The risk, which I would say, of course, what many people have been talking about, is some of the bad debt or the non-performing loans coming from China. So this can be a big question mark. So if you want to invest in Chinese banks, you have to accept the fact that could be surprises in terms of the bad debt which they might own, because China doesn't really report fully their entire loan book to their investors, right? Because it's such a huge entity, it's impossible to share with big accuracy. So there's always that room for error when you invest in Chinese banks. Having said that, this room for error, as a personal investor, I would want to give myself a much higher margin of safety. So while Singapore banks, I'm looking at 6%, Chinese banks, I would be looking at Chinese banks when they're trading at about 8% or even 9% dividend yield, which I've previously shared, over the last 1-2 years when China and Hong Kong is in a struggling bear market. And for me, I have been a long-term shareholder of Chinese banks, the big four banks. So what I like is, again, looking at dividend yield cycles. When Chinese banks, they are trading at very good historical high dividend yields, that's where I want to actually start picking and accumulating. When Chinese banks are trading at low dividend yield like what we are seeing now, which is roughly about 5-6%, then I might want to sort of release the gas pedal and sort of put on the brakes for accumulating some of these banks. Because the risk profile for Chinese banks is a bit different for Singapore banks, right? You're still dealing with policy uncertainties coming from the central government. You're also looking at non-performing loans, which might not be fully disclosed to investors or the public. So this is what I will look out for. Having said that, if the dividend yield is right, if you are willing to accept the risk coming from this Chinese bank, then yes, I would actually accumulate these Chinese banks. And these are also one of my favorites. At the end, it's also a good diversification away from looking at just our three locals banks today. So, if you're looking at dividends for me, I'm always looking at global dividends, and that's how I invest for dividends.
Great. So you listen 30, 40 minutes. The conclusion is the ship has sailed. But you are empowered, right? So you learn. This is the framework. And I think that's the whole thing about investing, right? And then being able to pick good stocks. A big part is understanding how to think about it. So when the time comes and, you're prepared for it rather than chasing, like the FOMO and energy, right? So yeah, we hope you learn some good stuff today. If you would like to continue to follow us and stay up to date with what we are doing, you can go to thefinancialcoconut.com and put your email there. So I update you about events, everything, it will come, right? And if our audience would love to follow you, then dividendtitan.com, then can sign up. I think he has a few programs and launches coming up. With that, thank you for your time. Thank you. We'll see you next week. Bye-bye.